Good morning, everyone, and thank you for joining us on this webinar. I'm Shaun Dawson, Head of Insights at Devono. Today's session is really about helping occupiers stay in control and what is shaping up to be a possibly more complicated year for workplace decisions. And to help me do that, I'm joined by Chris Lewis, Head of Occupier Advisory at Devono, and Phil Legg, co-founder of business rate specialist ForeView. So the office market has changed quite noticeably over the past 18 months. We're no longer in a recovery phase from COVID, and we're not really in a downturn either. We're now in a period of underlying adjustment. Costs are rising, supply is tightening, and decisions are becoming harder to reverse. So rather than trying to predict the market, the aim of today is practical guidance. What is actually happening, what it means for occupiers, and what you should be thinking about rather than later. So I'm going to kick off looking at 2025 and what that told us about the office market, then bring in Chris to talk about occupiers and how they're responding in practice, and then bringing in Phil, who will cover business rates, which is becoming one of the biggest overlooked costs heading into 2026. So 2025 wasn't a weak year for the office market, but it was a year where dynamics shifted and continue to shift increasingly over the latter part of 25. Leasing volumes softened somewhat, but the important change was behaviour. Businesses continued to delay decisions longer, with some deals announced in 2025 having been in the pipeline for 12 to 18 months. But those that did commit did so with decisive moves, whether that was type, quality of space, location, or even size. And on that point, we saw fewer transactions in 2025, but larger commitments to space, which tells us companies were not really reducing the importance of the office. In fact, the opposite. Businesses have become more cautious about not getting things wrong, so actually future-proofing a little bit more. At the same time, availability across major markets began tightening beneath the headline numbers. On paper, supply still exists. In central London, that figure is 22.5 million square feet, but the number of genuinely suitable options amongst that is reducing, particularly when you align size, location, quality, and timing, especially as some of the larger deals in 2025 have taken options off the table, securing space pre-development completions, thus limiting options further. So with only a dozen or so new build opportunities coming through in 2026 in central London, and even less in 2027, there is a little bit of a kind of a heightening of competition in the market for space. And that leads me on to rents, which is another layer that we saw kind of shift over the course of 2025. So rents in London in some markets are now higher than the baseline was 5 years ago. And even 2 years ago, we've seen a further shift of rents. I'm going to flash up, this is me trying technology now, the rent slide, and this is me failing at technology, so hopefully everybody can see a rent map with 5 years, and I'm going to come back to this map a little bit later, but you can see here by the colours in the red and the purple, a lot of heat within the central London office market in the centre of that market in terms of rental profile, so upwards of 41% growth in some markets. But if I go back to this slide, just to kind of sum up 2025, the themes from the year were consistent: compromise on choice, hesitancy in decision making, rising occupation costs, and then that pressure on high quality supply. So those behaviours are important because they're not temporary trends, they are adjustments, with businesses having to align their workplace strategy accordingly. So if we jump into 2026, and on the screen you'll see our predictions from our upcoming occupier report, which is due out tomorrow. And what does 2026 look like? Well, it's a continuation of the pressures that I've just mentioned, if not an amplification of them. We expect 5 things. So first of all, cost pressures are becoming structural. We've got workforce costs, rent, technology, investment, business rates are all moving together at a similar pace. Occupiers are no longer managing a single cost increase, they're managing a layered cost environment. Secondly, we've got talent, and that talent is now shaping property decisions more than ever. The office is being judged less on efficiency and more on its role in attracting, training, and retaining people. That changes how businesses evaluate location and quality of their spaces. Thirdly, we have regional markets gaining more relevance and more strategic relevance, not as an alternative to London, but more of part of a risk and cost management strategy. Companies are thinking more about resilience rather than expansion. Fourth, sector growth. So some sectors will continue to expand regardless of economic conditions that are out there, particularly those linked to regulation, resilience, and technology adoption. And it's those businesses that are still keeping the market quite competitive, especially for high quality buildings. And so will be very present over the coming year for the hunt for space. And then finally, early planning becomes essential because supply is tightening. Competition for those spaces is being maintained. So the penalty for late decision making is increasing quietly rather than dramatically. So there are 5 kind of trends for the year. So 2026 is less about whether the market improves and more about whether occupiers and businesses adapt early enough to operate within that. So it's at that point I'm going to bring in Chris. So I'm going to get rid of the slides. Chris, you're advising occupiers on a daily basis. Are these market conditions that we've just heard about actually changing how tenants are approaching decisions?
I think there's no doubt that tenants are looking at things with a lot more time. So I guess the number one change is projects are starting, regardless of size, almost a lot sooner, a lot earlier than perhaps the 9 or 12 months prior to an event that historically we've seen. And I think that's largely because people are still coming to terms with exactly what space they want, never mind what they're going to find. We're constantly advising them that the longer the runway they can give, the better, because there are just so many options and there are so many potential outcomes that a client might ultimately land on. If you throw into the mix different ways of consuming space, so whether that's traditional leasehold, whether it's subleased space, whether it's that sort of hybrid managed option, which is neither flex nor leasehold, but somewhere in between, and seems to have really struck a chord with the market. People need time to understand what those options look like, how that translates. But fundamentally, I think for our clients generally, and for the market as a whole, it appears that flexibility around not just that type of space that you're taking, but also where you might choose to locate. So historically, you might be wedded to a certain location. I think all bets are off now for most firms as to where they locate. It's very rare now to have a client who says it's fundamental to my business to stay within 5 streets of this particular location. And that's ultimately where the opportunity lies, as we'll come on to. But if you're looking for value, sometimes you've got to step outside your postcode.
Even if you're in one of those traditional sectors that have been wedded to certain postcodes, are we seeing a bit of a breakdown in that? It's almost kind of a kind of getting through to people's headspace.
Yeah, I think probably the most obvious example would be EC3 in the city, which is historically an insurance focused district. We are seeing tenants start to sort of bleed into EC2. There are deals happening in 1 or 2 of the towers at the far end of Bishopsgate now for tenants who previously have been core EC3 occupiers. But that's a response directly to the fact that there is just no stock. You know, if you're looking for a certain quantum of space in that submarket, it just doesn't exist. And so, you know, the juggling act, what you need to weigh up is the importance of having the right location, in inverted commas, versus having the right space and that opportunity to bring people together, to build culture, to differentiate. And I think actually the world has just moved on a little bit and people are able to get their head around making those moves, which, you know, to us, a street or two sounds crazy that could be a barrier. but it has been for many years. And we've seen previously one or two insurance companies step out of EC3, but then relatively quickly try to step back in again. I think that's probably changed.
So has that kind of trying to make those decisions and trying to kind of incorporate looking at other areas, has that really factored in to the whole kind of search journey being extended in a time?
Yeah, I mean, typically speaking, I think a lot of businesses will now look at a number of different locations. Of course, they'll always have their preferred zone, if you like, but they will kind of spread their search appropriate to both the requirement but also the perceived lack of optionality that exists. And so being able to not necessarily wed yourself to a location or a West End versus City, all the rest of it, but being open to London, central London, is really important. And ultimately, that's an evolution of a trend that we probably saw happening pre-COVID, if I'm honest. But I think the way the market's moved, the lack of supply, as you reflected on, and all of the costs that go with different locations, people want to explore other options. And of course, we shouldn't forget that actually, in a market that is relatively tight on stock, staying put, doing deals with existing landlords, that is a really active part of the market. And it's a direct response to both cost and supply pressure.
So at what point is kind of waiting for that next, whether it's a lease event or a break, becomes more expensive or kind of more challenging so the kind of trying to hold back from being quite prudent about making these decisions? What needs to be that?
I'm not sure it's about. I'm not sure people are making decisions based on a prudent outcome necessarily. They're making a decision based on a perceived lack of either optionality or good optionality, whatever the decision they end up making. I think it's more to do with, at that point in time, if you give yourself enough time and you've got visibility of current and future supply, how do you then address your strategy to suit that? And that might be that you agree a short-term extension, and we've done plenty of those with clients, to give yourself a window to acquire the space that you think is best for you, or it might be to stay where you are, or it might be just to move early and take a view on the liability you leave behind. I think the key is flexibility for the business, but ultimately giving yourselves time. The one caveat to that, I would say, is I don't think occupiers fear lease events in the way they used to. A break is different, because a break, if you miss the break, you've missed the break. But very few businesses fear an expiry, particularly if you're sub 20,000 feet. Because if you do get to the end of a lease and a landlord just won't entertain terms with you to stay, what's the worst that's going to happen? You're going to work from home for a bit. You're going to take a flex space. You may do a managed deal relatively quickly. There are options and routes now that cure that issue of kind of lease termination, lease exit. So from a landlord's point of view, it's quite challenging, because that threat that they had is less impactful now, because there are options in the market that deal with it, and there's a heads sort of space, if you like, within clients' perspective that deals with ultimately that risk and that end of lease point.
And the market talks about the market being in the favour of landlords or tenants. Do you think tenants are fully aware of kind of how much power lies in their hands? To your point about kind of having that flexibility of different options and re-gearing, and are they fully aware of the spectrum?
It's a very interesting market, because at certain ends of the market, arguably the power sits with landlords just because of that supply challenge. I think the power for an occupier is pragmatism. If you can be pragmatic in the way that you're approaching your property situation, and that's pragmatic about your approach to negotiation, it's pragmatic about your approach to location, all of the various elements, then I think you have power.
Yeah.
Because you're not restricting ultimately the outcome that you might land on. So I think they probably feel they have more power, just general power, and are surprised by the dynamics of the market. I think a lot of businesses are surprised just how strong, particularly in London, the market is for office space. But if you use who you are, what you're offering in the best possible way, and you create a strategy around how you deploy that message, then absolutely tenants have power in these situations, even in a strong market like London.
So when I commented earlier on about rents being high and higher than what they were 5 or even 2 years ago, so is that still in the hands of a tenant to? Because you could look at some of I'll flash up the rent map again, and some of those markets that we're looking at, this Clerkenwell, Farringdon, north of Oxford Street, upwards of 41% rental growth. As somebody on looking, you'd think, oh, actually.
Look, I said earlier, it's pragmatism, and that means it's kind of that much used word holistic in your view and your outlook. If you're just looking at rents, it's a pretty uncomfortable message for occupiers at present in London, particularly on the good space. But if you're looking at the deal, if you're looking at the package, then I think there are reasons to be optimistic, and that might be around incentive package, it might be around contributions from a landlord, it might be around lease commencement dates, it might be around lease exit points, a whole myriad of things that are on the table to talk about with landlords. The only thing you have to remember as an occupier of space is that a landlord is focused on the value of their building, and the value of their building is driven off 2 things really, or 3 things. First is rent, second is term, and the other is covenant strength. So if you can find a way of ticking all 3 of those boxes, then a landlord will work with you.
Yeah.
Of course, it's going to be landlord specific, and different landlords will have different views. But as I say, pragmatism.
So this is where, if you, and I talk about in the predictions for 2026 about businesses starting these conversations early. So whether it's the lease expiry, whether it's the break, and having an open conversation, whether it's with the landlord or whether advisors such as ourselves, that will start to mitigate some of those kind of headlines, I'm assuming.
Yeah, and it will also give a business time to respond, because there may be a very real outcome that, you know, your property costs are going to double, triple even. So as a business, you need to understand, well, how do I deal with that? How do I address that? Is that with a bold location move? Is it with a different hybrid policy resulting in less footprint? Is it taking a short-term lease versus a long-term? You know, what is my route through? And the benefit of time, the benefit of extra runway, is that you're just able to give yourselves as a leadership team within that business time to develop and deliver a strategy rather than react and potentially get in a position that is suboptimal for the business.
So layer on the rent and anything else that is on the occupational cost front, we start to bring this one in. Who I say this one, but Phil, business rates has become an agenda item over the past 6 months, and it's not necessarily because of the revaluation that's happening in April. There's actually a more immediate deadline coming up. Could you explain a little bit more as to, and I suppose that kind of follows on quite neatly from Chris's kind of talking about the whole package.
Yeah, okay. So I think business rates, Chris has done a great description there around the sort of rental position. I think business rates is that kind of forgotten a little bit. I think it's sort of a little bit of an afterthought. Again, we'll come on in a moment to why we've got to bring that to the fore. But I think one of the key things that occupiers can do in the short term, okay, is look at the rating lists operate in 3-year windows. Okay, so at the moment we're on the 2023 rating list, which takes us from 2023 to April 26. Okay, people are reading quite a lot about the revaluation in April 26. It's absolutely something that people need to prepare for, occupiers need to prepare for in terms of that change of cost, not only rateable values but also a change in multiplier package. One of the things that they shouldn't miss out on is that opportunity to review what they have paid over this last 3 years. Okay, the appeals process that exists is a 3-stage process. There is a deadline, 31st of March of this year. I think it's 25 odd working days, something like that. Okay, is when an occupier has to have submitted the first stage of that process, a check. If they don't submit a check by that process, then they can't they're not in the appeals process, and they miss that opportunity to potentially explore the opportunity for a 3-year refund. And certainly one of the things that we're advising occupiers is and whenever there's a deadline, there's a mad rush, and we're very busy as an organisation at the moment, and we're providing opinions. We're being asked, okay, what does it look like we've paid over the last 3 years? Is there an opportunity? I think one of the key things about this current rating list from 23 to 26 is it's based on what the rateable values are based on what the rental value is at April 21. Okay, and if we all take ourselves back to April 2021, it was a COVID impacted market. There were very few transactions done, so that the actual level of evidence that exists for the valuation office to work with in arriving at their 23 rateable values is quite limited in central London. So herein kind of lies the opportunity, and certainly we've had a lot of success on behalf of our occupier clients in achieving reductions back to 23. Every week the rating list updates. Again, every week you see what we describe as tone movement across central London, where you see pockets of reductions to buildings. Okay, that provides really good evidence, okay, for occupiers to kind of leverage and their agents to leverage, and the importance is you've got to be in it, okay. So you've got to have made that decision by the 31st of March to either yes, okay, the 23 RV looks high, or actually no, we're okay. You've paid at the lowest possible level. Either or is good advice. Yeah, if you paid at the lowest possible level, that's that reassurance that you haven't been overcharged. But it's certainly time is of the essence here, because you miss it, and there could be nothing worse than seeing that your neighbours benefited for a big reduction, but because you're not part of the process, you miss out on it. So it's act now, okay? Yeah. Because onboarding and getting an opinion in advance of 30 March, there's a very short window.
And to do that, I suppose, what's the quick thing?
Quick thing is to reach out to your agent, reach out to ourselves as ForeView, but get an opinion. Okay, and we can give an opinion very quickly as to where we think, which direction we think we can potentially take it, and if we think that the reduction is apparent there or possible, then we move forward at pace to make sure we're within inside that window. There's also the other one, when we're looking back at business rates, it's also looking at how you occupy the space. Is there any reliefs available? And there's a whole, there's various different relief packages. Were you impacted by building works? Was there a disturbance to your property at any point? There's a load of different opportunities that occupiers should absolutely consider in terms of their rates liability. The other thing that's equally as important is and we'll come on to this in a moment, is that there's some big jumps in rateable value between the 2023 and the 2026 rating list, and some of those increases aren't necessarily going to be seen in the rates bill, because there's something called transitional relief, which effectively phases those increases in. So what becomes really important is making sure your baseline liability, i.e. your 2023 rateable value, is as low as possible, because that can generate a saving into the future if you can ensure that a reduction is secured on that. So act now to look at the 23 rateable value.
So would you say that business rates are underestimated at the moment, and or overlooked in terms of part of the overall occupational cost?
I think increasingly there's, and I guess the retail, hospitality and leisure have done a very good job in sort of banging the drum in terms of how hard hit they've been by business rates. I think offices a little bit have been ignored. So I think I think they are underestimated by a lot of occupiers. What I would say, and credit to firms like Devono, whenever shortlisting of properties takes place, okay, Chris and the team are reaching out to me to say, okay, what does the rates position look like? And it's not what does the rates position look like today, it's what does the rates position look like in 2 or 3 years' time. Okay, can you give us a guide on that? Because whilst the package of service charge estimates or rental estimates over a 5-year term for a certain shortlisted property might look favourable, you put the rates on top, and actually if that's the highest, suddenly you've got to look at the occupational costs as a whole. So one of the things that I guess gets underestimated is that is you do need to think about these things. Rates is absolutely got to come part of that thought process when you're at that kind of shortlisting process. I think one of the things, and I think Shaun, you might be able to share a slide here, but there's rateable values follow rental levels. Okay, so the slide that we prepared here basically speaks to probably the rental growth bubbles and the heat map where we saw the greatest rental growth. So I think probably the highest growth area in terms of from the 2023 to the 2026 rating list is that of Fitzrovia and Marylebone. Okay, we've seen big increases there. I think that mirrors the kind of rental levels usually, and that possibly speaks to that, maybe that stepping outside of the St James's, Mayfair, Comfort potentially, and moving slightly north of Oxford Street, but they're going to be hardest hit by rateable value increases through at April 26. The other thing to kind of overlay on top of that is it's not just about rateable values. Okay, it's also the multiplier package. Okay, at the moment, the multiplier package on this current rating list is fairly straightforward to understand. Okay, multipliers going forward, there's various different layers. Okay, and such things as geography, where you're located, impacts the multiplier you pay. The size of your rateable value very much dictates what your rates liability will be. Your asset class, what sector are you in? Are you an office sector or are you retail? So that will impact the multiplier. And also the percentage change in rateable value. If you've gone up a lot, okay, then there'll be something called transitional relief that might help in that kind of that bump in liability. I think one of the key things, this is a really good example, because of all these different layers, it's become more complex. Trying to identify what someone's going to pay from April 26 isn't quite as simple as maybe it used to be. Okay, so that's where you have to lean on your agent, your advisor, to absolutely get to the bottom of exactly how that will look. A good example is if you have a 500 grand rateable value in the City of London, okay, your multiplier is going to be circa 56%, okay, i.e. your tax rate. So for 500 grand rate, you will pay 56% in rates liability. Okay, there's a few supplements that are still to be confirmed, but that's the rough estimate. However, if you were street over in Islington, okay, and your rateable value is 499,000, then your multiplier might be close to 51%. Okay, so suddenly just by being in a different geography, your rateable value being slightly different, you've got a sort of 10% swing in tax rate. Okay, so that's again another really, really key consideration, that it's not just simply has the rateable value gone up a load, it's okay, where does it fall within certain brackets, certain geography locations and the like.
So I'm going to throw this over to Chris now, but would business rates be a factor? Is it an afterthought when looking for a property, or now is it becoming more key when looking at the overall credentials of a space?
I think it's a consideration. It's a shock, particularly when we start suggesting where rates may be going to. I wouldn't say it's a driver particularly. Obviously, very early in the process, we report on all costs associated with buildings that we suggest. So there's absolute visibility, and clients will look at total cost and make decisions sometimes based on total cost. So very expensive business rates, for example, may be filtered out. The reality is, if you're looking at a collection of buildings broadly all in the same area, within a certain tolerance, they're probably going to have a similar business rates profile, asset specific, of course. So yeah, it's a consideration. I think it's a frustration, but it's a tax, isn't it? And ultimately, it's very hard to get around taxes.
I think one of the key things here is what we always remember is business rates follow rents. Okay, so where something performs, a sub-location performs really well. Okay, Farringdon might be a really good example. Where we're sat today might be a really good example of that, where rental markets have grown in recent years. Okay, and the perception always been, well, the rates look on the potentially on some locations on the favourable side. So you think, okay, well, great, well, that's a really good. Come the revaluation, obviously that rental growth that's been experienced in the last couple of years, that's going to come out in the actual rates bills received. So one of the things, I guess, that really helps your overall kind of rates tax liability into the future is to make sure you're having professional advice on what actually terms you can agree, because that is going to come back to get you. Okay, so the higher net effective rent you look to agree, the higher your rates liability is likely to be in the future. So the two things connect and they control each other, I guess. So yeah, something just to bear in mind.
I was going to ask a question. I've got a question here, which is what is the most expensive mistake businesses could make around business rates? So I think you might have.
Yeah, I think the most is to ignore. Okay, if you ignore it, okay, it's going to come and catch you. I think the thing that we always advocate at ForeView, and the reason why we work with your business very well, is that we're proactive. Okay, because there's often opportunities to reduce your liability from a move processor's perspective. As a general rule, no single move happens where you come out on one day into the other on the next. There's an overlap, there's double overheads. That's that whole situation. If you proactively manage that position with the valuation officer, local authority, with your client, with the agent, with a firm potentially undertaking fit out, you can manage the process to minimise that exposure through the move process. So that's one thing you should absolutely do. If you're considering a move and the shortlisted options, it's then looking, okay, is there a way to efficiently manage the liability profile from moving from X building to Y? Okay, so that's one thing to do. But yeah, don't bury your head in the sand, because business rates will always come back. Again, it's a tax, and sometimes there's a delay in it. So you move into space, and it might be 3, 4, 5 months down the line before you get your backdated bill. Okay, so tackle it early. Don't bury your head in the sand, and make sure it's part of that overall conversation around where your business wants to occupy space.
Ultimately, it's a legitimate process. It's a legitimate challenge, isn't it? And
Absolutely.
It's a tax. Your business is a taxpayer. You have the right to check and challenge what's being charged.
Absolutely. And people often overestimate that. There's no catches to this. Rateable values are an opinion of rental value. It's someone's opinion as to what that space is worth at a certain point in time. And so, having the right to be able to say, well, actually, I don't agree with that opinion. I actually think it's worth less than that, and here's some evidence to justify it. It's absolutely, you need to do that. And I think as we move to the 2026 rating list, okay, the other thing that occupiers should be aware of is the appeal process is protracted. Things can take 12, 18, 24 months to come to come through. So one of the things that I think people need to think about it early. Okay, 26 rating list goes live in a few weeks. Okay, make a decision, decide how you're going to approach it, and again, execute on it. If the answer is the rateable value appears too high, start that process. Okay, start it early, because from a cash flow perspective, it will mean you're not having to pay over the odds for a longer period of time. Yes, there's always the right to claim it back to April 26, but be proactive on it if the RV does look to be excessive, and seek professional advice.
And those 2026 rating bills will start dropping on.
They'll start. Start of March, you'll start seeing bills. So my recommendation anyway is when the rates bill lands, send it to your agent, send it to a professional to give you initial opinion as to how that kind of appears, and also to check the calculations. That because, as I said, the multiplier packages become so much more complex because of the different supplements involved. Make sure you are actually being charged on the correct basis. And as a business ForeView, that's something that we just do as part of the process. So we encourage clients and non-clients to send us bill, and then we give an initial view and see if there's an opportunity for us to work with the occupier to try and reduce that overhead.
I think you've clearly painted a picture of why business rates shouldn't be that overlooked element and should be front and centre of property decision making.
Absolutely, yeah.
So with that, I've got a few questions, but we'd also like to open it out to everybody kind of watching and listening. So if you've got any questions that you'd like to ask us, pop a few into the Q&A, and we'll get to them. In the meantime, what matters the most in 26? Is it location, cost certainty, or flexibility? And I suppose it's both for both of you.
I think from my point of view, what matters most is that you alight on a solution that meets the strategy of your business. The real estate should never be the tail that wags the dog in these scenarios. And I think obviously on our side of the fence, where we're dealing with property all day and every day, we get very excited about it and think it's very, very interesting and important. And of course it is important, but what's much more important is the kind of corporate objectives, if you like, that our clients have. And so the development of a proper brief, the development of a proper strategy and approach, informed by people like us who will give visibility on market sort of trends and all the rest of it, ultimately will lead us to finding a solution. It is impossible that we will not find a solution. Whether that's within an existing building, in a new space, whatever the scenario. So the key is be really clear about what the objective is for the office, and then make sure you kind of brief the hell out of it in terms of locking down exactly what those requirements mean and how you need to implement, and then get out there in the market and find solutions.
And I suppose we've mentioned earlier on about flexibility and the fact that there's so many different options out there. So there could be a stopgap option. There could be one short-term, 3, 4, 5 years. Yeah. So there's definitely a route for every business now.
And it's not those routes aren't pegged to certain sizes or scenarios. You know, we will see people doing flexible deals with headcounts of 400. You know, it's not, and by flexible I mean, you know, managed, maybe flex as in service, but more likely managed, or short-term subleases, all the way through to, you know, traditional long-term leases. You know, the solution matrix is pretty wide and complex now. And from our point of view, when we report to clients, we'll always look to kind of give visibility to all of the options that exist in the market, not just the sort of traditional types of spaces and lease solutions, because it's really important that people understand the art of the possible and throw that into their considerations. But it comes back to that earlier point that we talked about around time, and giving yourselves time to really understand the position and then make the right decisions for your company.
Without giving you the answer, I'm assuming that's the same for you, isn't it?
Exactly. I mean, I think that the key thing with the rates advice from the outset in this shortlisting sort of conversation that Chris is having here, it's allowing better decision making. So if you know what the profile looks like now, but also for the future in terms of liability, and if the rateable value's gone up a low, there'll be transitional relief. But as that wears off, the transitional relief, it will be purely rateable value times multiplier. That can be a big number, and it can look very different from the quoting rent, for example, that's in the marketing particulars. So where the rating advice comes to is actually that helping in that decision making. Okay, us providing the liability profiles so that you can consider it all in the round.
We have got a question that's come through, which is: occupier clients are frequently reporting increased pressure from landlords to conclude transactions rapidly, particularly given stronger demand for pre-lets. Does this signal a broader shift in market conditions, and is it a trend you expect to remain?
I think it's a very good question. I mean, we always try and manage efficiently the legal process around documenting deals and getting deals concluded. The frustration actually is that landlords aren't always on that same page, and so I'm constantly surprised by the time it takes landlords to process deals. And I'm not totally sure why that is. So there are some landlords who are extremely proactive and very, very good at running a process that's speedy. But I would say they are the outliers broadly from our experience. But you know, it comes back to the point earlier. Landlords in some scenarios do have the upper hand, and so they will try and sort of play the tune, if you like. But it's for our clients, it's for us managing that process to just make sure, if it is a quick process, it's running properly. We have time to properly review and analyse documents and ultimately get to the right place. But equally, we work really closely with clients, legal representatives, to make sure they have everything they need to deliver. But I certainly wouldn't say that it's common practice that things run super quick and super smooth from a landlord point of view.
The question mentions about pre-lets, and obviously if there are very few options coming through over the next 2 years, is it a case that landlords are holding out for the better tenant, not necessarily the better tenant, but the better?
I mean, look, there may be an element of that, but equally there are not that many businesses who are pre-letting very big buildings. You know, yes, they're happening, those deals are happening, but it's not like there's a queue of tenants waiting to sign these pre-lets. So if you're a landlord, what that means is if you've got one, you want to get them signed up. And of course, there's a plus if, you know, maybe the market moves on, and if you didn't do that deal but did another, the rent's up a little bit. But actually de-risking a development early on and getting somebody signed up is kind of really critical. The one thing I would say is the complexity in London, probably around pre-lets in particular, but landlords as a general rule, is that, you know, rewind 30 years ago, 40 years ago, when the last round of big pre-lets were being done, generally speaking, it was all UK developers, big, well-known UK developers who kind of are tried and tested, know exactly the process. Fast forward to now, a lot of the pre-lets, there's still some UK, but they're overseas. They're either US or they're Asian investors, and their reporting process, their way of delivery is very, very different. Some of those to the better,
Yeah.
but some of those it just adds layers of complexity and delay. So it's kind of not one size fits all.
I suppose leading to, we've got another question that's come through, which is about tenant demand, and has the drive to get employees back to the office affected tenant demand?
100% it has. Probably what we all thought would ultimately happen is happening. So, whether it's formally this or not, it feels like 3.5 to 4 days in the week is now kind of the norm. The moment you get over 3.5 days in a week, to be honest, you've got to have space for everybody, because you never have an equal spread of those 3.5 days. It's everybody comes in on a couple of days, so you basically need space for everybody. But yeah, 100% we're seeing people not only get back to where they were, but actually in many cases, particularly where businesses perceive that there might be a future space struggle, you're seeing people taking more space and then just banking that on the basis they'll grow into it in due course.
So that knee-jerk reaction that we saw in 21, 22, reduction of space by, in some cases, up to a third, that's kind of drifted away now. And I suppose if what we're seeing from an analysis point of view is that, yes, we're seeing larger commitments, we're seeing more and more kind of shorter deals that are happening. So the flexibility is starting to feed into people's decision making.
Yeah, look, I think that the whole kind of post-COVID reaction to office space, which clearly we didn't agree with at all, but you might say we're biased. I think that was just a process that people had to go through. There was trauma, and there were these great big expensive offices, and great big could mean 2,000 feet to a 10-person business. That's basically just costing you money, and no one's coming in. It's never being used. What are you going to do with it? So you change your view. I think, fast forward, we're now where we are, and as I've talked about, things are back. What probably the really useful byproduct for all of our clients, for all occupiers and businesses, is the reaction from the landlord market to that whole kind of process was this flexibility of delivery that I talked about. So shorter leases, managed products, all sorts of different solutions that would deliver businesses with a different way of taking space that gave them that inherent flexibility. And so, in a funny kind of way, whilst it was a pretty unpleasant 2, 3, maybe even 4 years from 2020, the long-term impact on the market and optionality for businesses around taking space has been massively positive.
So those who've not taken those steps and not kind of changed their approach, would you say that indecision in property decisions is now the most expensive kind of strategy? Holding back from and just say, oh, well, we'll just renew for another year, or let's not kind of go down this route?
Well, look, as I talked about earlier, it depends what your ultimate objective is. And, if you can be pragmatic about what an ultimate solution might look like, there are going to be ways through it. I wouldn't say, buy now because, sale ends on Friday. It's not that kind of scenario. But of course, there'll be some submarkets, and the maps earlier showed where the trend has been. There'll be some submarkets that will continue to grow because there's just a lack of supply. But that will be to Victoria's benefit from St James's. That will be to Canary Wharf's benefit from the city. We'll see people moving south into Southwark and taking some of the big buildings. So you'll just see this like as the sort of the lava of rent increase spread through London. You'll just see it flow into these other areas. So whilst I'm not saying we'll see huge increases in rent in Canary or some of those, Hammersmith or other locations that are perhaps slightly secondary in terms of that primary focus, there's definitely going to be an upside because we've got to see that spread because of a lack of supply and an increased cost.
So on a cost point, what will be the biggest cost to businesses this year? Is it going to be the rent? Is it going to be the rates? Or is it what we've been discussing, a combination of...
If you're talking about a one-off cost, I think probably still the elephant in the room is fit out.
Okay.
it's still extremely expensive to fit space out, just because of the cost of materials, and that's shown no sign of reducing. And in fact, it's probably normalised at or around where it is now. So I think as a one-off cost, if you're asking about this year, it probably remains fit out. But again, that for some businesses, that will push them in the direction of managed delivered space, because it's just an easier way to consume. You're not faced with a bill day one. You can just amortize that, let someone else take the headache of that initial cost, and then ultimately concentrate on maybe a slightly higher OPEX, but a predictable OPEX with no bumps.
Okay. Phil?
I think I've concentrated my discussion mainly on kind of the losers as a result of the revaluation, i.e. the ones where the rateable value's gone up the most and going to be harder hit by the highest supplements in terms of the multiplier. I think there's a load of winners out there as well. There's a Canary Wharf as an example where rental values obviously have compressed and they haven't gone forwards. Obviously with the multipliers coming down, okay, there's some winners there. And maybe to Chris's point, these different sort of the flowing out of the core locations that we all associate with, maybe one of those drivers is going to be actually not only are landlords keen to get people into somewhere like Canary Wharf, but also the rates package that goes along with it sits at a lower basis to other locations. So I think, again, rates very much follows the market, but there are some winners out there. There's very much some winners, and that the heat map that we shared earlier kind of outlines that, but also from a multiplier perspective, and there's some cliff edge kind of stuff in terms of, the difference of your rate value is 500k or 499k is a massive difference in terms of your tax rate. So there's some considerations there.
Conscious that we might be kind of running out of time, we've got one more question from the Q&A. From a market perspective, how are sustainability requirements now influencing landlord competitiveness?
It's a very, very good question. In fact, I was reflecting on this with somebody only last week. I think that probably over the last 10 years, sustainability into energy performance, into ultimately ESG as a kind of global category that people talk about, it's risen up the agenda massively. But it's done so to the point now where it's a given. And so I think most occupiers now will just assume that a building ticks all of the boxes, because you'll go out on tour and you're told about, how many thousand tons of carbon was saved in the refurbishment of this building. You'll be told about the photovoltaic cells on the roof. You'll be told about the number of cycle spaces and showers in the basement, all of that stuff. And actually, by the time you've gone to your fifth building and you've heard the same story, you've kind of zoned out. So I think people just assume now that it's a box that's been ticked. So it's almost like you look at it the other way around. It's not how important is it that you've got it. It's almost like how detrimental is it that you haven't? Because I think if you're not able to tick those boxes now as a landlord, as an owner, it sticks out like a sore thumb.
So from a competitive point of view, that the question was asked, yes, it is competitive, because if you don't have it,
it's kind of not even competitive. It's like it's an essential.
Yeah.
If you haven't done it, if you haven't ticked the boxes, and whatever those boxes might be, and there have been one or two buildings, by the way, that have been delivered over the last 12 months, all gas.
Okay.
And then the PC has been delayed because they've converted that all gas building, which is a very, very large building in central London. They've had to convert it to electric because they recognise actually all of their big tenants who have their own internal ESG policy they'll just exclude it because it's a gas building.
So it is. So in those cases, it is being driven by tenant demand.
Yes, but it's an assumed position now. Businesses assume that a building that is modern or new or refurbished will tick all of the boxes. Okay. So if you don't deliver that, then it will bite you.
On that note,
mic drop.
Mic drop. On that note, my last question for you both is: what will occupiers regret not doing 6 months from now?
Appointing Devono.
Appointing ForeView to look at the rates position retrospectively for the 23 to 26 period, and taking the 26 change seriously in terms of taking early action.
My less
Phil owns it, so seriously.
my less flippant answer is that I think it's entirely kind of event dependent. You know, if you've got no break, you've got no expiry, you've got no rent review, there's not very much you can do in the next 6 months, to be honest. If you've got an event that's 12, 15, 18, maybe even 24 months away, yeah, maybe this next 6 month period, you do start really trying to understand what the requirements are of the business and trying to get visibility and have foresight around those issues, rather than leaving yourself late, the runway too short, and ultimately having to be reactive.
So early 2028 is not out of the question in looking at anything.
Not at all. Not at all. 24 months is quite normal. Even if it's go out, have a think, have a look, and then retreat for 6 months. It doesn't matter. It's just getting your head in the space of thinking about the whole kind of project, the market, and what's coming down the pipes.
Excellent. Well, thank you for being here. And to close, we just want to leave everyone with some practical actions rather than market commentary. So the occupiers who engage early will have more choice, more leverage, fewer surprises. Those who wait will find out that the market still has space, but not necessarily the space that you're looking for. So 3 takeaways would be, from my perspective, is firstly, fully understand your occupational costs and not just the rent. Secondly, engage with the market earlier than feels necessary. And then thirdly, treat the workplace strategy as a business decision and not just a property event. So it's fully immersed. So if any of these items resonate with people on the call, we'd be very happy to talk through your position and help you understand your exposure ahead of any decision making. So thank you for joining us, and thank Chris and Phil for being here. As I said earlier on at the top of the call, our latest edition of the Occupier will be out tomorrow, but everybody on the call will be receiving an email with a link to that. And anybody who requires CPD accredited, do get in touch and we can send you through the details on that one. Thank you very much.